Okay, let's unpack this. We're starting today by acknowledging something pretty fundamental about finance right now. The whole system, it just feels, well, complicated, doesn't it?
It really does. Almost deliberately so sometimes. Our sources, they talk about things like, flying robots trading at the speed of light.
Right. And it feels like the whole setup is kind of designed to keep the average person feeling confused, maybe a bit overwhelmed.
Exactly. And when you're confused, you tend to give up control, right? You hand it over, along with fees, to people who seem like they know better.
So our mission today really is to cut through that noise. We want to give you a sort of shortcut.
Yeah, a detailed blueprint, actually,
Yeah.
to help you become more of a financial insider. We're pulling together the wisdom, the actual strategies from people who've genuinely succeeded.
And these aren't just talking heads. We're talking, what, insights from 50 really top players.
That's right. Self-made billionaires, Nobel Prize winners, major financial figures. We've distilled their core ideas into basically a 7-step plan.
A plan for financial freedom. And crucially, one that's built to work no matter what the market's doing, right? Thrive in any condition.
That's the goal. Survive and thrive. Because market weather changes.
And focusing on that proven track record, that's key for us. We're looking at people who actually did it, who walked the walk.
Absolutely. You don't want advice on building wealth from someone whose only wealth came from selling advice. It doesn't make sense.
We're after the kind of principles you could pass down, like the best inheritance, maybe even better than money itself.
It really is. And the foundation for all of this, it boils down to two main things. First, you got to understand the mechanics, the nuts and bolts of investing.
Okay, the how-to.
And second, maybe even more important, you have to master the psychology, your own mindset. You need to execute the plan consistently and fight off those biases and, frankly, the traps the system throws at you.
Okay, so mechanics and mindset. Let's dive into that foundation then. Mindset first.
Exactly. And the starting point, maybe surprisingly, isn't some fancy stock tip.
No complex algorithm.
No. It's actually a really simple, fundamental choice you make every single time you get paid.
Okay.
The sources are unanimous on this. The most critical decision is figuring out what slice of your paycheck you get to keep for yourself. Your freedom fund, let's call it, before a single dollar goes out for bills, rent, coffee, anything.
Before anything else, you pay yourself first.
You pay yourself first. It sounds almost too simple, but that single decision, that commitment, it shapes everything else that follows financially in your life.
It's not just about what you earn then.
Not at all. It's what you keep. And then, crucially, how you put that kept capital to work for you. This is about making a promise to your future self.
Locking it away automatically, like a bill you have to pay.
Precisely. A non-negotiable payment to the most important person, future you.
And when you do that, you immediately plug into, well, the magic of compounding, right? Where time becomes your superpower.
Absolutely. The ultimate asset. There's this great story from Burton Malkiel, the economist. He talks about two brothers.
Oh, yeah, I think I know this one.
Right. One brother starts investing early, puts in a modest amount, and actually stops investing pretty young. The other starts later, but invests way more money for a much longer time, trying to catch up.
And the early starter wins, right? By a lot.
By a landslide. The brother who started earlier, even though he invested less overall, ended up with something like 600% more money, 6 times more, just because he started sooner.
Wow, 600%. That really drives home the power of time.
It's immense. Time is the one multiplier you just can't buy back later. Or look at Theodore Johnson, worked at UPS.
Okay.
He has followed this exact rule, paid his freedom fund first, consistently invested in UPS stock through thick and thin. By the time he was 90, those small, steady actions turned his investment into over $70 million.
$70 million. From a regular job, just being consistent.
Exactly. He wasn't some Wall Street wizard. He was disciplined. He understood time in the market.
And you don't need a huge salary either. I remember reading about Osceola McCarty.
Oh, what an incredible story. A washerwoman in Mississippi. Very humble means.
Right. No fancy financial background. But she had what the sources call penny wisdom.
Just consistently save small amounts. Put it away, let it earn interest, let time do its thing. And by age 87, she'd accumulated enough to donate $150,000 to a university scholarship fund.
Amazing. $150,000 from saving pennies, essentially. It shows the mechanics work if you just stick to it.
It really does. But here's the catch. Despite these clear, powerful stories, most people just don't do it, or they start and stop.
Yeah. Why is that? If it's so simple, why the failure to execute?
This brings us straight to the psychological side. The consensus from these financial giants. 80% of success in this game is psychology. Only 20% is the mechanics, the how-to.
80% mindset. Wow.
Yeah. So if you have a good strategy, save first, invest consistently, and you're still not getting there, it's almost certainly because of a limiting story you're telling yourself.
A limiting story? Like what?
Things like, oh, this investing stuff is way too complicated, I need an expert. Or, I just don't make enough money for savings to matter. Or that really common one, the whole system is rigged against the little guy anyway.
I can see how those would stop you before you even start. They become your reality.
They absolutely do. They cap your potential. And this connection between our story and our reality, it's not just philosophical. There's actual science here.
Like what?
There's a fascinating Stanford study on stress. For years, we thought stress was just plain bad for you.
Right. Avoid stress at all costs.
But this study tracked people with high stress levels, and they found something crucial. The people who had high stress and believed stress was harmful to their health, they had a 43% higher risk of dying.
Okay, that sounds bad.
But here's the kicker. People who experienced the exact same high levels of stress but viewed it differently, maybe it saw it as energy, the body getting ready for a challenge, they had no increased risk of dying compared to low-stress groups.
Wait, so the stress itself wasn't the killer, it was how they thought about the stress.
Precisely. The story they told themselves about the stress literally changed their body's physical response and their long-term health outcome.
That's incredible. So applying that back to finance.
If you're stuck, not saving, not investing,
Yeah.
it's probably not because you don't know how, the 20% mechanic.
Yeah.
It's much more likely an 80% psychology issue. You need to identify and change that limiting story. See the challenge of saving not as deprivation, but as empowerment.
Okay, that's a powerful foundation. Master the mindset first, change the story, then what?
Then, step 2 is about becoming that insider. Knowing the rules of the game, and maybe more importantly, knowing the myths that are out there specifically designed to trip you up and take your money.
All right, let's debunk some myths. Where do we start? You mentioned fees earlier.
Yes, myth number 2, the fee trap. It often comes with this reassuring line like, oh, our fees, they're just a small price to pay for expert management.
Sounds reasonable, right? A small percentage for professional help.
It sounds reasonable, but this is probably the most damaging myth because the true cost is often hidden. That expense ratio they advertise, that's just the tip of the iceberg.
Just the sticker price, you're saying.
Exactly. It's usually just the management fee. Underneath, you can have a whole slew of other costs. Things like 12B1 fees, which are basically marketing costs passed on to you. High trading costs if the manager is constantly buying and selling. Soft dollar costs, maybe even redemption fees if you sell too soon. There could be over 10 different potential fees.
10. Wow. Okay, so what does that actually add up to? What's the real impact?
The cumulative effect is devastating. Based on the analysis from these experts, the typical actively managed mutual fund with all these layers of fees could end up consuming as much as 60% of your potential investment returns over your lifetime.
60%? Hold on. You mean if my investments could have grown to, say, $1 million, I might only end up with $400,000 because of fees?
That's exactly the potential impact over long periods. It's like trying to fill a bucket with a massive hole in the bottom. Compounding works viciously against you with fees.
Can you break that down, like with an example?
Sure. Let's take 3 investors. We'll call them Jason, Matthew, and Taylor. They each start with $100,000.
Yeah.
They all invest for 30 years, and let's say they all get the same 7% return before any fees are taken out.
Okay, same starting point, same growth rate.
Right. Now, Jason invests in something with high fees, let's say 3% total cost per year. After 30 years, he ends up with around $324,000.
Okay.
Matthew's a bit more careful, finds something with 2% total fees. He does better, ends up with about $432,000.
Better, but still a big chunk missing from the potential.
Now, Taylor is really diligent, finds low-cost options, keeps total fees down to just 1% per year. After 30 years, Taylor has nearly $575,000.
Wow. So Taylor, just by paying 2% less in fees than Jason, ends up with, what is that? Almost double the money.
Almost double. Same initial investment, same market returns. The only difference was the fee drag. It's massive.
That's shocking. So the insider move here is what? Aim for really low fees.
Absolutely. The goal should be to keep your total all-in investment costs, fees, trading costs, everything to 1.25% per year or less. And honestly, in today's world with low-cost index funds and ETFs, you can often get broad market exposure for way less than that, like 0.05% to 0.15%.
Okay, 1.25% max. Got it. That fee example is powerful. But you also mentioned that even the returns they advertise can be misleading. Myth 3.
Yes, myth 3. Returns aren't always what they seem. You see a fund advertise, say, a 10% return for last year, but then you look at your own statement and your personal return feels lower.
Yeah, that happens. Why the disconnect?
It's because of how they calculate those advertised returns. Funds typically use something called time-weighted returns.
Time weighted. Okay, what's that?
It basically calculates the return as if you invested one lump sum of money right at the beginning of the period, say January 1st, and didn't touch it all year. It smooths things out and makes performance look consistent for marketing brochures.
But that's not how most of us invest, right? Especially in something like a 401k.
Exactly. Most of us are putting money in regularly, every paycheck, maybe monthly, into an IRA. That reality is captured by a different calculation, the dollar-weighted return.
Okay, dollar weighted. That sounds more like my actual dollars.
It is. It reflects the actual return on the dollars you invested, considering when you invested them. And here's the problem. Investor behavior often works against us.
How so?
People tend to chase performance. They get excited after a fund has had a great run, so they pile more money in then, near the highs, and they get scared and invest less, or even sell when the fund is down.
Buying high and selling low,
It's
basically.
a classic mistake.
Yeah.
Because you're putting your biggest chunks of money in near the peaks, your personal dollar-weighted return often ends up being significantly lower than the fund's advertised time-weighted return.
So the marketing number looks good, but my actual experience, my wallet, feels different because of when I put the money in. Another way the system can be misleading.
It really is. And thinking about who is often recommending these funds brings us right to myth 4, the broker conflict. The friendly pitch. I'm your broker. I'm here to help.
Okay, what's the conflict here?
The core issue is that most people don't know the difference between a broker and a true fiduciary. They sound similar, but legally, they're very different worlds.
Explain that difference. If I go to my big bank branch or a well-known brokerage firm, who am I talking to?
Often, you're talking to a broker, or technically a registered representative. They operate under what's called a suitability standard.
Suitability, meaning what?
Meaning, they only have to recommend products that are considered suitable for your general goals and risk tolerance. They are not legally required to act to your absolute best financial interest.
Wait, not required to put my interests first.
Correct. Their primary loyalty might be to their firm. They are often compensated through commissions or incentives tied to selling specific products, maybe the firm's own mutual funds, which might have higher fees. So the recommendation might be suitable, but not necessarily the best or lowest cost option available for you.
That feels like a huge conflict of interest right there.
It is. The alternative is someone who is legally obligated to put your interests first. That's a fiduciary. Typically, this is an independent registered investment advisor, or RIA.
An RIA, okay.
Yeah.
And they have to disclose conflicts.
Yes, they have a legal duty of loyalty and care. It comes back to that Upton Sinclair quote, right? It is difficult to get a man to understand something when his salary depends on his not understanding it. A broker's salary might depend on selling you the profitable product, not necessarily the best one.
Is there evidence this actually happens, that managers don't always have skin in the game?
Oh, absolutely. There was a sobering Morningstar study back in 2009 that they looked at thousands of actively managed funds, and they found that in 49% of them, almost half the fund manager personally owned 0 shares in the fund they were managing for other people.
Half the managers didn't even invest their own money in their fund. The chef isn't eating his own cooking.
Exactly. If they don't believe in it enough to put their own money on the line, why should you? It screams conflict or lack of confidence.
And what happens when this conflict goes really wrong?
Well, look at the Enron disaster, a classic, tragic example. Even as the company was crumbling, riddled with fraud, major Wall Street brokerage firms kept telling their clients to buy or hold the stock right up until it was basically worthless.
Why would they do that?
Because those same firms were earning enormous investment banking fees from Enron for other services. Their advice was compromised by their own firm's interests. A true fiduciary wouldn't have let that happen. They would have had a duty to warn you, regardless of banking relationships.
Okay, that's a stark warning. Avoid brokers, seek out fiduciary RIAs. What about the common retirement vehicles themselves? Myths 5 and 6 involve 401ks and target date funds.
Right. The 401k itself represented a massive shift in the retirement landscape. We went from pensions, where the company guaranteed you an income for life, a defined benefit,
The old model.
to the 401k, a defined contribution plan. Now, the company might contribute, but all the investment risk and often a lot of the fees falls directly onto you, the employee. The company's liability was significantly reduced.
So the risk shifted from the corporation to the individual.
Entirely.
Yeah.
And within that 401k world, target date funds, or TDFs, became super popular, almost the default option everywhere.
Why did they become the default?
Largely because of a federal law in 2006. It basically gave employers some legal protection, reduced their liability. If they offered TDS as the default choice for employees who didn't actively pick their own investments, they were marketed as simple, set it and forget it.
The idea being they automatically get more conservative as you get closer to retirement, right? Shifting from stocks to bonds.
That's the idea. But the problem is, they often don't reduce risk enough or in the right way when things get really bad. They give an illusion of safety.
How so? What happened in, say, 2008?
In the 2008 crash, they really didn't protect people as much as expected. TDFs, designed for people already near retirement, supposedly safer, still fell about 17% on average.
Ouch. That's not exactly safe if you're about to retire.
Exactly. And the TDFs for younger people, like those retiring in 2055, they got hammered, falling almost 40%. They just weren't diversified enough against that kind of systemic shock. They failed the stress test.
So not necessarily the safe harbor people thought they were.
And one more point on 401ks, especially for business owners listening. You, as the plan sponsor, have a fiduciary duty under ERISA law to ensure the plan options offered are prudent and the fees are reasonable.
So the liability is on the business owner.
Yes. The Department of Labor has been cracking down on plans with excessive, often hidden fees. If your company's 401k is loaded with high-cost funds sold by a broker, the legal liability could fall on you, the owner, not the broker who sold it. So vigilance is key.
Okay, lots of pitfalls and myths cleared away. Now, how do we actually build the wealth? The positive strategy.
Right. Now we get to the constructive part, the architecture. And it starts, again, not with picking investments, but with defining your goals really clearly. You need to calculate the price of your dreams.
The price of your dreams, what does that mean?
It means getting specific. Most people have this vague idea like, oh, I need millions to retire, maybe $10 million, $20 million. It feels overwhelming, impossible even.
Yeah, those big numbers can be paralyzing.
Exactly. But usually people haven't actually done the math. What does your desired lifestyle actually cost per year? What income do you need for basic security, for full financial independence, for ultimate freedom, maybe including travel or philanthropy? Clarity here is incredibly empowering.
Can you give an example of that?
Sure. The sources mention a couple, Ron and Michelle. They lived a nice lifestyle, about $350,000 a year. They had dreams, a boat, a ski place, plus they really wanted to give $100,000 a year to their church.
Okay, so specific goals.
Right. When they sat down and actually calculated the annual income needed to cover all of that, it came out to $515,000 a year.
Still a big number.
It is. But then they translated that income need into the amount of capital they'd need, invested their money machine to generate that income safely. Turned out it was about $10.2 million.
Okay.
And here's the key. While $10.2 million is a lot, it was actually only about half the huge, scary number they'd had vaguely floating around in their heads. Suddenly, it felt achievable, not impossible. It turned their stress into focused motivation.
So defining the target makes the journey feel possible. Get specific.
Get specific. Clarity is power. Once you have that target number, the single most important investment decision is asset allocation.
Asset allocation. Heard that term a lot. What does it really mean?
It's simply how you divide your investment money among different types of assets, or different buckets, as the experts call them. And literally everyone, Nobel laureates, top hedge fund guys, big institutions, they all agree this is the key to long-term success, far more than picking individual stocks.
Okay, so how many buckets are we talking about?
This blueprint uses three main buckets. Bucket number one is your security bucket, or peace of mind bucket.
Security. Makes sense.
This holds the money you absolutely cannot afford to lose. Its main job is to provide certainty, which is a fundamental human need. This is your defense against panic when markets go crazy.
What kind of things go in the security bucket?
You want safe, stable assets, ideally things that don't move in lockstep with the stock market. So things like high-quality government bonds, like U.S. Treasuries, they tend to do well in deflation or crises. Also, TIPS Treasury inflation-protected securities, which protect you if inflation spikes unexpectedly. Maybe some CDs too, though returns can be low.
Safe and steady, but maybe not much growth.
Traditionally, yes, but there are some really interesting insider tools you can use in this bucket that offer safety, plus some potential upside.
Oh, like what?
One is called a market-linked CD. Think of it like a regular CD from a bank. So it usually has FDIC insurance, meaning your principal is protected.
Okay, so my initial money is safe.
Right. But instead of just paying a fixed interest rate, the interest it pays is linked somehow to the performance of a market index like the S&P 500.
Interesting. So if the market goes up, I get some of that gain, but if it goes down, my principal is still safe.
Exactly. You get participation in the upside, often with a cap or a participation rate, but you have that floor of principal protection. We saw examples where these delivered, say, an 8% average annual return during a volatile period like 2009 with zero downside risk to the principal. Takes the fear out.
That sounds pretty attractive for the security part.
Yeah.
What else?
Another powerful tool, especially for longer-term security money, is a fixed indexed annuity, or FIA. Now, annuities can be complex and sometimes controversial, but a well-structured FIA from a top-rated insurance company offers some unique benefits.
Like what? I know they offer principal protection.
Yes, 100% principal protection is core. The insurance company guarantees your base amount. And like the market-linked CD, they offer upside potential linked to an index, again, usually with a cap or spread. So if the index is up 10%, you might get, say, the first 6%.
Okay, so there's that trade-off again, the cap on the upside. Why accept that?
You accept the cap in exchange for two really critical features. First, that downside protection, you can't lose money due to market drops. Second, and this is huge, FIAs typically offer locked-in gains.
Locked-in gains, what does that mean?
It means if the index goes up and your account is credited with a gain in a given year, that new higher value becomes your new protected principal amount. Your account value can essentially only go up or stay flat based on market performance. It never steps backward because of a market decline. It creates a rising floor over time.
So your gains get locked in and protected from future losses.
Exactly. It smooths out the ride tremendously and provides a lot of certainty for that core security bucket.
Okay, that's bucket one. Security, certainty, maybe with tools like FIAs or market-linked CDs. What's bucket two?
Bucket two is your risk growth bucket. This is where you're playing to win. The goal here is maximizing your returns over the long haul. This is for money you likely won't need for at least, say, 10 or 15 years, ideally longer.
So this is where the stocks come in.
Absolutely. Equities or stocks are the main engine here. Historically, they offer the best potential for long-term growth, even though they come with volatility. This bucket might also include things like real estate, maybe income-producing properties or REITs, real estate investment trusts.
Any other tools for the growth bucket?
For people with more assets or sophistication, you might see things like structured notes. These are more complex, but they can offer partial downside protection, maybe protecting you against the first 25% of losses in exchange for potentially amplified upside, maybe getting 150% of the market's gain if it goes up. Higher risk, higher potential reward.
Okay, growth bucket is for the long term, taking calculated risks for higher returns. What's the third bucket?
Bucket three is the dream bucket. This one's often neglected, but it's really important psychologically.
Dream bucket sounds fun.
It is. This is a relatively small slice of your overall assets, maybe 5% to 10% max. It's for, well, your dreams. Or just fun money, things you want to invest in that maybe aren't purely rational.
Like what sort of things?
Could be anything. Maybe investing in a friend's startup business, buying a piece of art you love, funding that passion project, maybe even that slightly speculative stock tip you heard about, with money you can afford to lose.
And the purpose is?
The purpose is to keep you emotionally engaged and reward yourself along the way. It prevents the whole financial plan from feeling like this long, joyless slog towards some distant future goal. Having a little fun with a small portion keeps you motivated and disciplined with the bigger buckets. Oprah apparently had a wild dream of owning property near her favorite Fiji resort. It started in the dream bucket and eventually became a significant asset.
Okay, I like that. Security, growth, and a little bit for dreams. Now, how do you put these together, especially considering market ups and downs?
That's where the strategic architecture comes in. And one of the most powerful models comes from Dalyo, the founder of Bridgewater, the world's largest hedge fund. He developed what's called the All Seasons portfolio.
All seasons, I've heard of that. What's the core idea?
Dalyo realized that the traditional investment advice, just put 60% in stocks and 40% in bonds, has a fundamental flaw.
The 60-40 portfolio, what's wrong with it? It's been standard for decades.
The flaw is that it looks balanced based on dollars allocated, but it's not balanced in terms of risk. Dalyo pointed out that stocks are roughly 3 times more volatile than typical government bonds.
3 times? Wow.
Yeah. So in a standard 60-40 portfolio, even though only 60% of the money is in stocks, Those stocks actually account for something like 85% or more of the portfolio's total risk, its potential ups and downs.
So when the stock market crashes, that 60/40 portfolio pretty much crashes too because almost all the risk was in the stocks anyway.
Precisely. It's not truly diversified against different economic environments. It's really just betting on stocks doing well most of the time.
So what was Dalyo's insight? How does All Seasons fix that?
His genius was recognizing that different assets perform differently depending on the economic season we're in. He simplified it down to 4 basic environments.
4 seasons,
Like periods when economic growth is rising, periods when growth is falling, periods when inflation is rising, and periods when inflation is falling or deflation. Every asset class tends to thrive in one of these seasons and struggle in others.
Okay, so stocks like rising growth, bonds might like falling growth or deflation, commodities like inflation, that kind of thing.
Exactly. So instead of just splitting $60/40, Dalyo aimed to build a portfolio where the risk was balanced across assets that do well in each of those 4 seasons. The goal is to have roughly 25% of your portfolio's risk allocated to each economic environment.
Risk parity, not dollar parity. How does that look in practice? More bonds.
It often involves holding more bonds than a traditional portfolio, yes, including things like treasuries and TPS. It also includes stocks and often commodities like gold, which can do well during inflation. The exact percentages are designed to balance out the volatility contributions of each asset class.
And does it work? What's the track record?
The historical track record, based on Dalyo's research and backtesting, is incredibly compelling. Over a 40-year period, from the volatile 70s up through 2013, the all-seasons approach generated average annual returns of nearly 10%. 9.88% was the number cited.
Almost 10% a year. That's impressive over 40 years. What about the down years?
That's the most impressive part. Over that entire 40-year stretch, which included multiple recessions, crashes, and inflationary spikes, the strategy only had 4 years with meaningful losses. And those were generally quite small compared to stock market declines.
So it smooths out the ride significantly, protects you from those big shocks.
Massively. It protects you from being surprised by whether the next shock is inflation, deflation, or a growth slowdown. But maybe even more importantly, it protects you from yourself.
Protects you from yourself.
By reducing the volatility so much. Think back to 2008. The S&P 500 stock index lost about 37%. Imagine seeing your life savings drop by over a third. It triggers panic. People sell at the bottom, locking in devastating losses.
Yeah, emotionally brutal.
But in 2008, the all-seasons portfolio was down only about 3.9%. When your portfolio is relatively stable like that, even during chaos, you're far less likely to panic and make that fatal emotional mistake. You can stay invested, stay the course. That psychological stability is almost priceless.
Wow. Okay, All Seasons provides a robust structure. Now, what if we want to reach our goals faster?
Right, because discipline is great, but achieving freedom sooner is even better. So the blueprint includes strategies to accelerate your plan. Strategy number 1 is pretty straightforward, but requires that behavioral discipline we talked about. Save more.
Save more. Easier said than done for many people, right? They feel stretched already.
True. But the sources argue we often leak more money than we realize through small, habitual expenses. The classic example is the latte factor.
Ah, yes, the daily coffee habit.
It's a metaphor, really.
Yeah.
It could be daily lunch out, subscription services you don't use, impulse buys online. That $10 a day habit, whatever it is, adds up to over $3,600 a year.
Which sounds like a lot, but maybe not life-changing.
But remember compounding. Invest that $3,650 a year instead. Over 20 years, assuming a modest 7% return, that's over $141,000 you missed out on. Small leaks sink big ships over time.
Okay, point taken. Find the leaks. What about bigger savings opportunities?
The really big wins are often in housing and debt. Take your mortgage. If you have a standard 30-year mortgage, just making one extra monthly payment per year, maybe splitting one payment into 2 half payments every 6 months, or adding 112th extra each month.
Doesn't sound like much.
It has a massive impact. That small extra payment goes almost entirely to principal. Doing that consistently can cut the life of a 30-year mortgage by nearly half. Maybe 7-8 years shaved off, potentially saving you hundreds of thousands in interest over the long run.
Wow, just one extra payment a year? That's a huge accelerator.
Huge. Or consider a more drastic move, relocating. If you live in a high cost of living area, could you move somewhere more affordable?
Like moving from California to Texas or New York City to somewhere in the Midwest.
Exactly. The data shows this can have a profound impact. Moving from, say, San Francisco to San Diego could save you over 30% on housing costs alone. Moving from D.C. to Raleigh, North Carolina offers significant savings. A single move could potentially boost your savings rate by 10, 20, even 30% instantly without needing a raise.
That's a big lever to pull if your lifestyle allows it.
It is. And one more savings trick. This one's behavioral. Commit to save more tomorrow.
Save more tomorrow. How does that work?
You make the decision today that the next time you get a raise or a bonus, a certain percentage of that new money will automatically go straight into your freedom fund, your savings and investments.
So you're pre-committing future income increases.
Right, because you haven't gotten used to spending that extra money yet. You don't feel the pinch in your current lifestyle.
Yes.
It makes increasing your savings rate psychologically much easier over time.
Clever. Okay, so save more is strategy 1. What's strategy 2 for acceleration?
Strategy 2 is earn more. And the most reliable way to earn more, according to the experts like Jim Rohn, is to increase your value to the marketplace. Invest in yourself.
Become more valuable. Makes sense. Especially now with automation and AI changing things.
Absolutely critical now. We face huge shifts. Mike Rowe from Dirty Jobs often points out this massive skills gap. There are millions of good-paying jobs available, maybe 3.5 million, he cited, that don't necessarily require a 4-year college degree.
What kind of jobs?
Skilled trades, electricians, plumbers, welders, HVAC technicians, specialized manufacturing roles, healthcare technicians, jobs that require specific training and hands-on skills. Only about 10% of those open jobs required a BA.
So opportunity exists outside the traditional university path.
Huge opportunity. And reskilling or upskilling is becoming essential for almost everyone because of automation. Oxford researchers estimated nearly half of current U.S. occupations face a high risk of being automated in the next couple of decades.
Half. That's staggering. Look at the example of truck drivers.
Yeah, think about 3.5 million truck drivers. Self-driving trucks are coming. They can operate nearly 247, potentially cheaper and safer. What happens to those jobs? The jobs likely to be safer are those needing complex problem-solving, creativity, emotional intelligence, managing people, or high-level technical skills working with the automation.
So investing in learning those kinds of future-proof skills is key to earning more.
It's probably the single best investment you can make.
Okay, save more, earn more. What's the third acceleration strategy?
Strategy 3 is all about tax efficiency. It's not just what you earn or what you save, but what you keep after taxes. And the consensus among these financial titans is pretty clear. Taxes are likely hitting higher in the long run.
Why is that? Government debt.
Massive government debt, unfunded liabilities like Social Security and Medicare. Someone has to pay for it eventually. So planning for potentially higher taxes in the future is just prudent.
So how do you become more tax efficient?
One of the most powerful tools available to almost everyone is using Roth accounts, Roth IRAs, Roth 401ks.
Roth. Okay, remind us how that works.
With a Roth, you contribute money after you've paid taxes on it today. So no upfront tax deduction like a traditional IRA or 401k.
Right, pay tax now.
But the magic happens later. All the growth inside the Roth account is tax-free. And assuming you follow the rules for qualified withdrawals in retirement, all the money comes out completely tax-free forever.
So you pay taxes at potentially lower rates today and avoid potentially higher rates on a much larger sum later.
Exactly. You're essentially locking in today's tax rates on your contributions and eliminating future tax risk on all the growth. If you expect taxes to rise, the Roth becomes incredibly attractive.
Makes sense. Are there other, maybe more advanced tax strategies?
For higher net worth individuals, yes. There's a strategy often called the rich man's Roth, though the technical term is private placement life insurance, or PPLI.
PPLI. Sounds complicated. Insurance.
It uses a life insurance structure, but it's really an investment vehicle. It allows accredited investors to put significant capital into a wrapper where it can grow tax-deferred, invested in things like hedge funds or private equity that aren't usually allowed in regular retirement accounts.
And the benefits.
Similar to a Roth, the growth is shielded from annual taxation. And withdrawals, if structured correctly as loans, can be tax-free. Plus, the death benefit passes tax-free. The impact of letting investments compound for decades without the drag of annual taxes is enormous.
How enormous? Is there an example?
Yeah, a powerful one. Imagine investing $1 million. If it compounds for 40 years and you pay taxes on the gains each year, you might end up with around $7 million.
Okay.
Now take that same $1 million, same investment strategy, same growth rate, but wrap it inside a PPLI structure. Because it compounds tax-free, that $1 million could grow to over $30 million over the same 40 years.
Whoa. 7 million versus 30 million, just from the tax treatment.
Same investment, same time frame. Just eliminating the tax drag makes it over 4 times larger. That's why it's a cornerstone strategy for the ultra-wealthy. Tax efficiency is a massive accelerator.
Okay, those are powerful acceleration strategies. What about the really long view, beyond just finances?
Right, we need to consider the context we're living in. Technology is advancing exponentially. This isn't just science fiction. It's impacting longevity, quality of life.
Like what kind of tech?
Think about 3D printing. We're printing organs now.
Yeah.
Nanotechnology repairing cells. Advances in genomics and biotech leading to life extension. The world your retirement savings will need to support might look very different.
So planning needs to account for potentially living longer, healthier lives.
Exactly. Ray Kurzweil, the futurist and head of engineering at Google, has this idea. Your goal should be to live long enough for the technology to catch up. Basically, stay healthy and financially secure enough to benefit from future breakthroughs that could extend your healthy lifespan even further. Financial freedom isn't just about money. It's buying time, buying options for the future.
That's a fascinating perspective, buying time for technology to catch up.
Which leads us to the final, perhaps most profound insight from these financial masters. Once you've built the machine, achieved the freedom, what's the ultimate point? What truly leads to fulfillment?
Good question. It's not just about the number, right?
Absolutely not. The masters, the people who've reached the pinnacle, they often stress that the ultimate form of wealth isn't the money itself, but the ability to fully experience life. You have to be careful not to win the money game, but lose at the game of life, sacrificing health, relationships, joy along the way.
Finding that balance.
Yes. And the surprising secret they often share about using money for happiness. The most fulfilling thing you can do with significant wealth is often giving it away, investing in others.
Giving it away brings more happiness than spending it on yourself.
The research is incredibly clear on this. Studies show people consistently report greater happiness and well-being when they spend money on others, gifts, charity, helping someone out, compared to spending it on themselves. It even seems to have positive effects on physical health.
That's powerful. The act of giving is rewarding in itself.
Deeply. And it doesn't have to be huge amounts. The act itself matters. It creates this virtuous cycle. Financial success enables generosity, which brings fulfillment, which motivates further positive action. Think of initiatives like Swipe Out Hunger, using small leftover amounts like campus meal points or pocket change to provide millions of meals. Small actions, huge impact. Financial mastery ultimately empowers you to make a difference far beyond yourself.
Okay, so let's try and wrap this all up. We've covered a lot of ground.
We really have.
It seems like the big takeaway is that financial success isn't really about luck or finding some secret stock tip or timing the market perfectly.
No, not at all. It's about having a solid strategy, understanding the rules, and crucially, controlling what you can control.
Like mastering your own psychology, that 80% mindset piece,
Yep.
being consistent.
Definitely. And aggressively controlling costs, especially those insidious fees that just eat away at your returns.
Understanding the difference between a broker and a fiduciary. Knowing who's actually on your side.
Critical. And then building that resilient portfolio structure, like the all-seasons model, that balances risk and protects you from panic.
And finally, focusing on accelerating the plan through saving more, earning more, and being super tax efficient.
Exactly. Building that robust financial machine. But there's that final piece.
Right. Don't get so lost in building the machine that you forget to live.
Precisely. The masters emphasize this again and again. Don't let the pursuit of wealth overshadow the experience of life itself. Cultivate gratitude along the way.
So John Templeton, the legendary investor, had a great quote on this, didn't he?
He did. He said something like, if you've got $1 billion and you're ungrateful, you're a poor man. If you have very little but you're grateful for what you have, you're truly rich.
Powerful words. So the final thought for everyone listening.
Maybe the ultimate question isn't just how much money you'll accumulate in the future. Maybe it's about what wealth you already possess today in terms of gratitude, relationships, experiences.
Start rich by appreciating what you have now, even as you build for the future.
Exactly. Start rich today.